Okay, let's unpack this. Today, we are diving deep into a company you absolutely see everywhere you look. Monster Beverage Corporation, ticker MNST. We've pulled together a stack of sources for this deep dive, including a really sharp investment memo, and our mission really for you is to figure out if Monster truly fits that description of a wonderful company. Something maybe worth considering for the very long haul.
Right. And it's fascinating when you start digging in.
Yeah, what's fascinating right off the bat, according to these sources, is what Monster isn't. They aren't primarily manufacturers or logistics operators. At its core, Monster is described as like a brand development and marketing powerhouse.
Exactly. They dream up the concepts, the identities, the flavors, and then they cleverly outsource the really heavy lifting, making the product and getting it onto shelves.
So the business basically runs on two main engines.
That's right. You've got the massive Monster Energy drink segment, the finished cans we all recognize, and then the smaller strategic brand segment, which is more about selling the proprietary concentrate to partners.
Got it. So over this deep dive, we're going to guide you through what the sources seem to highlight as most important. We'll explore the business model itself and what gives it that competitive edge, its moat, as they call it. Then we'll look under the hood at the management team, dig into the company's financial health, and finally, we'll tackle the big elephant in the room, the stock price.
Always the big question.
Yeah. Does what you pay for Monster today make sense given its value and, future prospects? We're doing the heavy lifting through these sources to show you what you need to know. So let's kick things off then by looking at the fundamental engine of this business. What really jumped out at me from the sources is this whole idea of being asset light. Can you explain what that means for Monster and why it's such a key part of their model?
Absolutely. Think about it this way. Most beverage companies own massive factories, bottling lines, delivery trucks, warehouses, just huge capital investments.
Right. Lots of money tied up.
Exactly. Monster avoids a lot of that. The asset light model means they focus their capital and their brain power on the things that really build value, creating that killer brand, innovating flavors, and spending heavily on marketing and sponsorships.
Yeah.
They essentially outsource the manufacturing and the complex logistics of getting the product from the factory to the store shelf.
Okay.
And the big win here, as the sources really highlight, is exactly what you said. It saves them a ton of capital and resources. They don't have billions tied up in physical assets that, depreciate. That capital is freed up. They can reinvest it in the brand or return it to shareholders.
Yeah.
Much more flexible.
Okay, so they save money by not owning factories and trucks. Simple enough. But how do they actually make money? Is it just selling cans to retailers?
Oh, it's a bit more nuanced than that. Yes, they sell finished product in the main Monster Energy segment, and that's definitely the bulk of the revenue. But they also, particularly in that strategic brand segment, make money by selling their proprietary concentrate to partners. Those partners then bottle or can it themselves.
Ah, okay. Like the secret sauce.
Pretty much. And the sources point out a key detail here. While the main Monster Energy segment has higher revenue per case, that strategic brand segment, selling just the concentrate, actually boasts higher gross profit margin percentages.
Interesting.
Yeah, they're selling that secret sauce at a very, very profitable rate.
Got it. And the sources made a point about the inherent simplicity and durability of this model. It's not going to be disrupted by some new app next week.
Exactly. That's a really key point. This isn't a business threatened by technological obsolescence in the same way, say, a software company might be. It's tied to, fundamental human needs. The need for energy, maybe you pick me up, sure. But also, crucially, the desire for identity and a belonging.
Right. The brand aspect.
Yeah, Monster has incredibly effectively tapped into that with its brand. So the model itself is simple, durable, and tied to something pretty timeless. Plus, they're riding a massive wave. The global energy drink market itself is huge, over $90 billion, and projected to grow significantly, maybe 8-9% a year through 2030. That's a structural tailwind.
Okay.
And that outsourcing strategy you mentioned, especially the logistics part, handled by companies like Coca-Cola, the sources frame that as a really smart risk mitigation play. It pushes operational complexity and the need for constant capital upgrades for things like truck fleets onto their partners. Monster doesn't have to worry so much about that.
So they've got a simple, durable business riding market growth and offloading risk. That sounds pretty good, but how do they protect that? What stops someone else from coming along and doing the same thing? Is this where the famous moat comes in?
That's precisely it. This business structure, being asset light, directly feeds into what the analysis describes as a dual-engine economic moat. It's made of two incredibly powerful forces working together.
Okay, what are they?
The intangible asset, which is the Monster brand itself, and the distribution network. The brand is absolutely foundational. It wasn't built by accident, right? They've cultivated this specific, edgy, youthful, high-performance identity, sometimes described as kind of blue-collar or even in-your-face.
Yeah, you see it everywhere. Very distinct.
It is. And it's a deliberate counterpoint to Red Bull's typically more premium, often extreme sports image. This brand just resonates deeply with their target audience, creating really strong consumer pull and mind share. People aren't just buying caffeine, they're buying into the Monster lifestyle.
Okay, so the brand gets people to ask for it. That makes sense. But getting it to them reliably, everywhere, that feels like the other, maybe harder, half.
It is, and this is where what the sources call a masterstroke comes in.
Yeah.
The strategic partnership they forged with the Coca-Cola company back in 2015 fundamentally transformed their distribution. Well, it gave Monster access to what is arguably the most powerful and extensive distribution system in the world. Coca-Cola became their preferred global distributor and critically agreed that Monster would be KO's exclusive energy brand within that vast system.
Wow, exclusive. That's huge.
It's a massive barrier to entry for competitors. And Coca-Cola has skin in the game they own, about 20% of Monster equity. So they're highly incentivized to make Monster successful through their network. Their interests are aligned.
Okay, so help me picture this. How does it work on the ground?
Think about a convenience store cooler, the prime real estate, right when you walk in.
Yeah.
Retailers want brands that move inventory fast and bring in traffic. Monster and Red Bull are usually at the very top of that list.
Makes sense.
So Monster secures that spot, not just because of its brand pull, but because the Coca-Cola truck is probably already stopping there anyway, stocking all the Coke products, right?
Yeah.
The KO distributor already has the relationships, they have the leverage, and they have a vested financial interest in making sure Monster is always stocked perfectly, right in your face. Plus, their agreements with KO distributors often prevent those same distributors from carrying competing energy brands.
Ah, so they block competitors too.
In many cases, yeah. It's this combination of powerful consumer pull meeting this unparalleled distribution push. It creates this incredibly strong, nearly impregnable fortress, as the sources put it.
Wow, seeing it like that through the cooler analogy, that really makes it concrete. You called it a fortress. Is it getting stronger? Is the moat widening?
The evidence from the sources definitely points that way. The most compelling data point is probably Monster's international sales growth. They went from about 25% of total revenue coming from outside North America in 2016 to 39% in 2022.
That's a big jump.
It is. And that's direct evidence of them leveraging the Coca-Cola global system to penetrate new markets. As they expand internationally via Coke, their global scale grows, brand recognition increases worldwide, and that distribution moat just gets deeper and wider.
And what about acquisitions? Did the Bang Energy deal play into this?
Yeah, that was another move that solidified things, though maybe more domestically focused. The acquisition of Bang Energy in 2023 for about $362 million. Bang was a pretty significant domestic rival, causing them some headaches.
I remember that.
By acquiring them, Monster basically eliminated a competitor, consolidated market power, and even gained a manufacturing facility in the process. It was described as an opportunistic masterstroke that further strengthened their position within their core market fortress.
Oh.
Ultimately, that KO partnership fundamentally changed the game. It turned the business into what the source calls a nearly impregnable structural fortress and created a kind of toll road model. Monster gets paid these high margins to run their brands through Coke's unparalleled global highway. Any competitor, they face an almost impossible task. They don't just need a great brand, they somehow need to replicate or gain access to a global distribution system that can compete with Coca-Cola's. Good luck with that.
Yeah, good luck is right. Thinking about that brand power, let's talk about the people actually drinking this stuff. What do the sources say about the customers? I've definitely seen chatter online suggesting it's, more than just a drink for a lot of people.
That's spot on. Looking at consumer sentiment, like comments on places like Reddit that were mentioned in the sources, you see really deep loyalty. It's almost tribal, this connection people feel.
Tribal, wow.
Yeah, it's not just about the caffeine hit. It's wrapped up in identity. Consumers are really engaged. They debate the best flavors online. They collect the different can designs.
And Monster seems to feed that engagement with their just massive product line, right? It's so many flavors.
Exactly. They have over 40 flavors, which sounds kind of crazy, but it's a huge driver of loyalty. Someone that might be completely obsessed with one specific variant,
Yeah, I know people like that.
And the success of their Ultra Zero Sugar line shows they can adapt to evolving health trends while still keeping that core brand edge. They didn't lose the monsterness.
Right.
This huge breadth of flavors. The long tail, as it's sometimes called, is actually a pretty smart competitive tactic. It keeps the brand fresh and relevant with constant innovation, always something new to try, and it creates really high switching costs.
How so?
Well, if you're hooked on, say, Pipeline Punch or Ultra Fiesta Mango, it's hard for a new competitor to just pop up with one or two basic flavors and pull you away. It makes their customer base incredibly sticky.
Okay, so we've got this killer brand running through an unparalleled distribution system, serving a super loyal customer base. What about the people running the show? Who's in charge, and how have they managed the company's finances?
Right, that's where we shift to management and the financials. Because a business this good still needs good people steering it. And Monster has had remarkable continuity at the top. It's been founder-led for over 30 years by Rodney Sachs and Hilton Schlossberg. They acquired the predecessor company way back in 1990.
Wow, 30 years.
Yeah, and the sources really paint a picture of an owner-oriented philosophy. They seem relentlessly focused on building the brand, dominating the market, and driving long-term value for shareholders. That seems to be the core focus.
Is there a succession plan in place?
There is. There's actually a planned leadership transition happening, which speaks to continuity. Mr. Sachs is moving from co-CEO in mid-2025, with Mr. Schlossberg becoming the sole CEO. Mr. Sachs will stay on as chairman, still involved, especially, they say, on the brand and innovation side. So continuity seems key.
Okay. And how do they use the company's money? We talked about low Capex because they outsource manufacturing, but where else do they invest? What does the capital allocation look like?
Yeah, looking at capital allocation, you can see a summary in, I think it's table 1 in the source material. Yes, Capex is low because they don't own the factories. Their primary reinvestment is actually in SG&A.
SG&A is selling general admin.
Exactly. Selling, general, and administrative expenses.
Yeah.
And for Monster, a huge chunk of that SG&A is marketing and sponsorships. They pour resources back into building that brand and getting it in front of people, which, makes perfect sense given their whole model.
Right. Feed the brand beast.
Yeah.
Now, you mentioned earlier that the Bang acquisition was a masterstroke, but the Canarchy Brewery deal wasn't so hot. What do their M&A decisions tell us about management's approach?
It's a really telling contrast, actually. The Canarchy deal in 2022, spending $330 million to get into alcoholic beverages, that was pretty clearly outside their core competency.
Yeah, beer and hard seltzer seems different.
It is. And it hasn't gone well. The sources note they've already taken over $180 million in impairment charges on it. It's a clear lesson, maybe in the risks of straying too far from what you know best.
Oh.
But compare that to the Bang Energy deal in 2023 for $362 million. That was opportunistic. Bang was in bankruptcy, Monster was actually a major creditor, and they were able to acquire their main domestic competitor at, frankly, a discount. They got a brand, eliminated a rival, and even gained a manufacturing facility they can integrate. That fits perfectly within their core energy drink fortress. Much smarter play.
So a mixed M&A record, maybe. But when they stay in their lane, they seem pretty sharp. How do they return money to shareholders? Dividends.
Historically, it's been exclusively through share repurchases. They've actually never paid a regular dividend.
Interesting.
And they've been quite aggressive with buybacks at times, including a recent large $3 billion Dutch auction tender offer.
Okay, hold on. A Dutch auction tender offer. What does that even mean? Sounds complicated.
It does sound a bit complicated, yeah. Think of a regular buyback as the company just kind of buying shares on the open market over time. A tender offer is different. It's a specific offer to buy back a large number of shares directly from shareholders, often at a premium to the current market price.
Okay.
Now, in a Dutch auction version, shareholders who want to sell can tender their shares by stating the price within a range set by the company that they're willing to sell for. The company then figures out the lowest single price that will allow it to buy back the total number of shares it wants. It starts accepting shares from the lowest offered price upwards until it hits its target. And here's the key part. Everyone whose shares are accepted gets paid that same highest accepted price.
Ah, okay. So it's a way to buy back a lot of stock quickly.
Exactly.
Yeah.
It's a mechanism they use to buy back a large chunk of stock quickly and aggressively. The sources see it as showing strong management conviction in their own stock price. They think it's undervalued and are willing to put serious money behind that belief.
Okay, that makes sense now. So putting a sort of rationality test on management. the KO partnership, the Bang deal, the aggressive buybacks that looks pretty owner-like focused. Canarchy was the stumble, but maybe they learned from it and are doubling down on their core strength.
That seems to be the read from the sources, yeah. Their strength clearly lies in dominating that core energy drink market, leveraging that powerful moat they've built.
Now let's look at the actual numbers. How financially strong is this company? I've seen Cable 2 referenced, and some of these ratios look pretty impressive on the surface.
They really are. Monster is described in the materials as a highly reliable earnings machine. I mean, they've been consistently profitable for over a decade.
Okay.
And look at the margin. They're always a key indicator of a quality business, right? Gross margins are consistently between 50% and 60%. That's really strong evidence of pricing power, thanks to that brand.
50 to 60%, wow.
Yeah. And operating margins are also excellent, typically in the 25% to 35% range. That reflects the efficiency benefits of that capital light model we talked about.
And what about those quality ratios? I keep seeing ROIC mentioned. What does that tell us? Why is that important?
ROIC, return on invested capital, is a really critical ratio. It essentially shows how effectively a company uses the capital it has invested in its operations to generate profits. For Monster, it's consistently outstanding, often over 20% and averaging around 17-18% over the last 5 years, according to the data. This is clear quantitative evidence of the moat at work. It shows they earn truly exceptional profits relative to the money they actually put into the business.
So they make a lot of profit on not that much capital.
Precisely. Another key point, free cash flow conversion. They are described as a prodigious cash generator. That means they turn a huge portion of their reported net income into actual usable cash they can decide what to do with. This robust cash flow, combined with their balance sheet, which is described as a fortress, is incredibly powerful.
A fortress balance sheet. What does that mean in practice? Like no debt?
Pretty much. It means they've historically had very little to no net debt. If you look at net debt to EBITDA, essentially, how many years of earnings it would take to pay off their net debt, it's effectively zero. They have virtually no debt compared to their earnings power. It's incredibly strong.
So high profitability on little capital, tons of cash flow coming in, and basically no debt. What kind of power does that give management? What can they do with that?
Well, the sources call it powerful optionality, because they aren't weighed down by debt payments or forced to constantly reinvest heavily in physical assets like factories. Management has incredible financial freedom.
Right.
They'd be highly opportunistic, whether that's seizing a deal like the Bang acquisition when it came up, launching a massive share buyback like that Dutch auction tender offer, or investing heavily in new growth initiatives. They can play offense when many other companies are stuck playing defense, maybe managing debt or struggling with capital needs.
Okay, so we've pretty clearly established this is a high-quality business. Powerful moat, strong financials, capable leadership, focus on the core. But let's be honest, quality rarely comes cheap in the stock market, does it?
No, it certainly doesn't.
How should we think about the price you have to pay for this kind of quality?
You're absolutely right to ask that. The market definitely knows Monster is a high-quality company, and as a result, the stock pretty consistently trades at a premium valuation. Looking at the numbers today, and Table 3 in the source material has a snapshot, the valuation metrics are demanding. The price-to-earnings ratio, based on the last 12 months of earnings, is hovering around 41x to 42x.
42 times earnings, okay.
Yeah. And price-to-free cash flow is also quite high, somewhere between maybe 34.6 and 39x, depending on the exact calculation. These are not low numbers.
Is that high compared to its own history? Does it usually trade this high?
It is a bit elevated right now, yeah. The current PE is higher than its 5-year average, which is closer to 37.6x. That said, it has traded higher, peaking near 44x in that 5-year period, and also lower, down around 32x at the low point. So it's within its historical range, but definitely towards the higher end.
So what's the verdict from the analysis? Is it too expensive?
Well, here's the crucial judgment drawn from the sources. The current price is considered demanding, but potentially fair for a true long-term investor.
Demanding but fair. Okay, unpack that.
It means the stock is not statistically cheap. You're not finding a bargain here based on current numbers. And the analysis suggests it's unlikely to ever be truly cheap in that sense, as long as the business performs as well. People are willing to pay up for this quality. So the investment thesis at this price point doesn't really rely on the valuation multiple increasing, like going from 40x to 50x earnings. Instead, it relies on the company's earnings and free cash flow continuing to grow at a rate fast enough over many years to justify this high starting valuation.
So you need the growth to make the math work.
Exactly. The price is high, yes, But the argument is that the quality of the underlying business is potentially even higher over the long term if that growth materializes as expected. Buying here requires strong conviction in that future growth story really playing out. It's a bet on continued execution.
And where is that growth supposed to come from, primarily? Because North America seems pretty saturated with energy drinks, right?
That's the key question, and the answer is overwhelmingly international. That's where the Coca-Cola partnership becomes so crucial again. As Table 4 in the sources hints with global market growth data, particularly in regions like Asia-Pacific, international expansion is seen as the primary growth engine for the future.
Okay.
North America is relatively mature, yes, but international territories are vast and, for Monster, relatively underpenetrated compared to their dominance in the U.S.
Yeah.
Coca-Cola provides that turnkey access globally. The truck's already there, the cooler relationships exist, they have the local expertise. This is seen as a multi-year, maybe even multi-decade, high-visibility runway for growth. Just filling in the map, basically.
Okay, we've covered the strengths, the quality, the potential for growth, but nothing's perfect. What are the big permanent risks that the sources highlight for a company like Monster, the things that could really derail this?
Yeah, every investment has risks. The most significant long-term risk consistently mentioned is regulatory and health scrutiny. The whole energy drink category is constantly in the spotlight.
Yeah, you hear about it.
You do. They face potential negative media attention, health-related lawsuits, and potential government actions like marketing restrictions, age limits, or special taxes. A major regulatory shift or just a fundamental negative change in public perception about energy drinks could seriously damage the brand and its ability to earn. That's probably risk number one.
Okay, what else?
There's also the risk of a major strategic misallocation of capital. We saw the Canarchy deal as a cautionary tale, right?
Right, the brewery mistake.
Yeah. Well, their fortress balance sheet allowed them to absorb that mistake without too much damage. A future, larger mistake outside their core competency could potentially destroy significant shareholder value. Management isn't infallible.
Fair point.
And finally, the sources point to the potential deterioration of the Coca-Cola partnership. This alliance is just the bedrock of their distribution moat. The current agreement signed in 2015 is set for 20 years, which provides a lot of stability.
Yeah.
But if that relationship somehow broke down significantly post-2035 or even before, it would be catastrophic for Monster's global reach.
Has there ever been friction there?
There was an arbitration case back in 2019 regarding Coca-Cola launching its own Coca-Cola energy drink, which Monster argued violated their exclusivity. It was resolved amicably, with Coke eventually discontinuing the product in most markets, but it showed that friction, while maybe unlikely, is at least a possibility. That partnership needs careful management.
Okay. Shifting gears a bit to what the sources call second-level thinking, trying to look beyond the obvious narrative. What's the general market consensus on Monster, and what's the sort of contrarian perspective offered in the analysis?
Well, the obvious first-level thought, which reflects the general market consensus, is exactly what we've been discussing. It's a high-quality company, formidable moat, great financials. But it always looks expensive or fully valued.
Right, the sticker shock.
Yeah, exactly. Analyst ratings often reflect this hesitation on valuation. You frequently see moderate buy ratings with limited near-term price upside projected. The market clearly sees the quality but gets hung up on that high sticker price. They're hesitant to pay up.
So the market sees the quality but maybe isn't willing to pay this much for it, or doesn't see much upside from here?
Precisely. But the contrarian view presented in the analysis challenges that conventional wisdom. It suggests the market might actually be underestimating just how durable and powerful the compounding effect of this business is over, say, the next decade or two.
Interesting. And why might the market be missing something? What are they potentially underappreciating, according to this view?
Several things are suggested. Firstly, the market might see the brand and the distribution network as two separate strengths, rather than fully recognizing them as a powerful reinforcing feedback loop.
A feedback loop.
Yeah. The powerful brand makes distribution easier and more valuable for Coke, and the incredible distribution strengthens the brand's ubiquity and mind share globally. This dynamic makes the overall moat wider and more resilient than just adding up the two parts separately. It's synergistic.
Okay, what else?
Secondly, the market might underestimate the sheer length of that international growth runway. How long can Monster keep plugging into Coke's massive global system and growing simply by penetrating these vast under-indexed global markets? The sources suggest this isn't a 2-3 year story, but potentially a multi-decade opportunity. The map is huge.
Right, just filling in the map could take a long time.
Exactly. And thirdly, the market might not fully appreciate or price in the long-term benefit of having these founder-operators, people like Sachs and Schlossberg, whose personal fortunes are massively tied up in the stock, making critical capital allocation decisions with that truly long-term owner-like mindset. That alignment can be very powerful over time.
So that high PE ratio we talked about.
Yeah, that high PE ratio, that's the first level reaction. Whoa, it's expensive. The second level thinking asks why it's high. And the answer is it's largely a consequence of the business's extraordinary quality, those incredible returns on capital, the fat margins, that formidable moat. So for a business of this caliber, that high PE might not be a sign of overvaluation in the traditional sense, but simply the necessary price of admission you have to pay to own such a superior compounder for the long haul.
The price of admission. I like that framing.
The contrarian bet here isn't really that the stock is statistically cheap. Today it's not. The bet is that the underlying business quality is so exceptional that it will continue to grow into this demanding valuation over many years, potentially delivering satisfactory compounding returns, even from this high starting point. It's a bet on quality and duration.
Okay, let's quickly synthesize then. Based on the sources we've reviewed, what's the quick bull case, the main reason someone would want to own this company?
Okay, the bull case in a nutshell. First, that nearly impenetrable moat built on the dominant brand, plus the exclusive global distribution via Coca-Cola. Second, superior financials, consistently high ROIC, prodigious free cash flow generation, and that fortress balance sheet giving them lots of optionality. Third, proven, owner-oriented management team with a long track record. And fourth, a clear long-term growth runway, primarily driven by international expansion leveraging that KO system.
Yeah.
That's the core bull thesis.
It makes sense. And the bear case, the main counter arguments are risks.
The main arguments against, or the bear case. First and foremost, the very demanding valuation, which leaves little margin for safety if growth slows down even slightly. Second, the persistent regulatory and health risk hanging over the entire energy drink category, which could damage the brand and earnings power. Third, the capital allocation risk, highlighted by that Canarchy mistake, reminding us they can stumble if they stray too far from their core. And finally, maybe some key person risk related to the ongoing leadership succession, even though it seems well planned.
Okay, got it.
So to sort of bring it all together for you, what we've explored today based on these sources is a business that appears, by almost every measure, to be of exceptional quality. It has a powerful, seemingly widening moat, incredibly robust financials, and experienced owner-oriented leadership. But, and it's a really big boldy but emphasized throughout the sources it trades, at a significant premium price in the market, a demanding valuation.
Right.
We've delved into this idea that perhaps for a business this fundamentally strong, that high price might simply be the cost of entry, the price of admission, as we said, to own something truly special for the very long term. However, as you heard, that thesis really hinges entirely on the continued, pretty much flawless execution of the growth story, particularly that international expansion through Coca-Cola playing out for many, many years to come. There's not much room for error priced in.
Okay, so we've seen how incredibly powerful Monster's brand and distribution are today, and how that combination has built this impressive business. But here's something to really mull over. A final thought drawn from the source's own challenge section, directly questioning that long-term perspective. What if that exact edgy, youthful, in-your-face brand identity, the very thing that has made them so successful and built that intense loyalty, starts to become a liability in the future? What if the next generation of consumers simply doesn't connect with it, or even actively rejects it, maybe gravitating towards something entirely different, something perceived as healthier, or maybe just cooler in a different way? How durable is cultural relevance, especially an identity so tied to a specific lifestyle niche over multiple decades? That's the deeper question that truly challenges the core of the long-term thesis here, isn't it? Something for you to think about.